Amidst the towering edifice of the U.S. economy lies a growing shadow, a debt ceiling reached and a delicate financial balance teetering on the edge of disaster. The suspension of the $31 trillion debt limit until January 2025 is just a band-aid on an ever-growing problem. But the real question arises: how can a nation grapple with its ever-worsening debt crisis by continually raising the ceiling time, and again, never trying to find ways to address or even acknowledging that there is a problem at all? The extraordinary mind of Dalio cautions against the dangers of unbridled borrowing and inflationary measures, urging for a comprehensive bipartisan plan to avert a catastrophic debt catastrophe. Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. The United States has reached its maximum borrowing limit, also known as the debt ceiling. This means that the U.S. government is unable to borrow new funds or issue additional bonds. Since January 19, 2023, the U.S. government has been using cash reserves and extraordinary measures to cover essential expenses. However, after 4 months, Treasury Secretary Janet Yellen urged Congress to take action, as the federal government faced a significant risk of being unable to meet its financial obligations if the debt limit remained unchanged. Despite the complexity of American politics, a resolution was achieved as a final agreement passed through the House on May 31st and the Senate on June 1st. Just in the nick of time, on June 3rd, President Joe Biden signed legislation to suspend the $31 trillion debt ceiling until January 2025. This measure averted a catastrophic U.S. default, providing temporary relief. However, it is essential to note that the new legislation did little to address the substantial increase in the total federal debt, projected to exceed $50 trillion within the next 10 years. Over the years, the U.S. debt ceiling has consistently increased since its inception in 1917. Since 1960, it has been raised, extended, or revised over 78 times. The debt limit represents the maximum amount of debt the federal government can hold, and it plays a crucial role in the functioning of America's economy. Since 2001, which was more than 22 years ago, the U.S. economy has been reliant on debt, using it as a means to pay its bills and meet its financial obligations. This situation highlights that the U.S. government's spending exceeds its annual tax revenue, leading to a cumulative borrowing of $31 trillion to fund its operations. In normal circumstances, for individuals or businesses to consistently loan money than they generate in revenues each year would undoubtedly lead to financial bankruptcy. However, the unique aspect of the U.S. government lies in its monopoly and control over the issuance of every U.S. dollar worldwide, which sets it apart from traditional financial scenarios. Additionally, the United States has run larger deficits during times of war, such as the Vietnam War and the Second World War. However, the dynamics began to change as we entered the 21st century. While conflicts like Afghanistan and Iraq were significant by most countries' standards, they were relatively smaller in the context of American history. Despite the conclusion of these engagements, the deficit has continued to increase, with limited checks or balances on the government's ability to print money as needed. The situation worsened following the 2008 financial crisis, wherein President Obama signed the American Recovery and Reinvestment Act of 2009, which infused $831 billion into the economy and added to the $1.4 trillion annual deficit. Implementing the Affordable Care Act in 2010, commonly known as Obamacare, has further exacerbated the budgetary predicament. The cost of this law, which significantly enlarged the scope of Medicare and Medicaid, has exceeded $7 trillion in 2022 alone, or about 23% of the entire federal budget. Now, Dalio is renowned for his approach to the all-weather portfolio, which diversifies beyond traditional assets like stocks and bonds, aiming to withstand various market crises. Although one might not strictly follow his portfolio makeup, it illustrates the ability of diversification and the utilization of other assets to navigate financial challenges. The current $31 trillion debt ceiling has resulted from a series of blunders and economic challenges that have accumulated over time. Since 2011, S&P reduced the national credit score from AAA to AA+. Thus, the possibility of a U.S. government default has loomed, particularly owing to worries about the budget deficits and mounting debt load. The debt limit was $14 trillion at the time, less than half of what it is now, indicating the tremendous rise in debt over the previous 12 years. Given that trajectory, it is likely that the U.S. government will continue to raise the debt ceiling in the coming years, leading to a decline in the value of U.S. government bonds, a reliable but low-yield investment option. This in turn exacerbates the problem, potentially leading to a loss of control over the escalating debt situation, especially if interest rates also rise. Amidst the situation, there have been claims from the White House regarding bipartisan efforts to protect economic progress and reduce deficits by nearly $1 trillion over the next decade. However, independent fact-checkers like CNN and factcheck.org have debunked this claim, pointing out inconsistencies in the figures. Ray Dalio's concerns regarding this scenario revolve around the continuous increase of the debt ceiling without any meaningful limits, which can lead to potentially disastrous financial catastrophe. As the U.S. government borrows more money, there may come a point where there is limited demand to buy the new debt. This could result in an inability to sell issued bonds, forcing the government to default on its debt obligations. To avoid such a scenario, two possible but undesirable solutions exist. The first option is to raise interest rates, which would lead to higher borrowing costs for the government and add further financial strain. The second option is for the Federal Reserve to print more money and buy the government's debt bonds, creating a somewhat circular and potentially inflationary situation. Ray Dalio believes that both these possibilities have negative consequences. Inflation could increase and debt holders might become inclined to sell it, worsening the debt imbalance. In either case, this could lead to a debt crisis similar to runs on banks, where government bonds become the subject of selling and the central bank faces pressures akin to a run on itself. If a U.S. government default were to occur, the consequences could be severe and far-reaching, both economically and socially. Financial havoc would be widespread, affecting most investors and financial institutions who hold government bonds, leading to a significant loss of value in their portfolios. The impact would not be limited to the U.S. equity markets, but could extend to global equity markets as well, given the extensive dominance of U.S. treasuries in the international financial system. Various government sectors such as defense, healthcare, transportation, and social programs could face disruption or even complete cessation of services due to funding shortages. Critical functions of society might be severely understaffed, hindering their ability to provide essential support and services. The social upheaval resulting from a default could be dire. Panic could spread nationwide, leading to shortages of essential goods like food, gas, and clothing. Unrest, riots, and an increase in crime and violence could be experienced as people struggle to cope with the unfolding crisis. Hence, Ray Dalio recognizes that structural changes are necessary to address this situation effectively. While short-term moves might be used as temporary measures, they should not be relied upon solely. A comprehensive and sustainable solution would be required to avert such a dire scenario and ensure the stability and resilience of the U.S. economy and society. Ray Dalio also suggests that a comprehensive and well-thought-out bipartisan plan is the most effective way to address the current debt crisis. Such a plan would require time to develop and would focus on economic reforms that aim to increase the nation's collective earnings, promote sustainable government finances, and ensure a fair distribution of resources. However, the likelihood of such a plan coming to fruition is low due to the self-interest of politicians and the challenges of overcoming extreme partisanship. The current political landscape in the United States makes it difficult to achieve bipartisan solutions to the nation's problems. Politicians often prioritize their self-interest and re-election prospects over making tough decisions that may not align with their party's ideologies. This leads to a lack of consensus and compromises necessary to address complex and long-term issues. To resolve the debt burden, the government would need to curtail its reliance on printing money to fund its operations and implement policies encouraging economic growth while reducing deficits. However, the prevalence of inflationary measures such as printing money may benefit the government by easing the debt burden but could negatively impact the general public, as it erodes the value of their savings and purchasing power. Dalio points out that the government's easiest way to pay off the enormous debt is through printing more money, which could be seen as a form of inflation. This approach might appear convenient, but it comes with its own set of consequences for the broader population. Inflation has been on the rise, and the government's efforts to address it have been questionable, with some actions potentially worsening the situation. The Inflation Reduction Act by the Biden administration seems to prioritize providing financial relief rather than effectively combating inflation. People in positions of authority may benefit from inflation, and expecting anything other than further inflation might not be realistic. To protect against inflation, investing in assets like real estate, stocks, and shares is advisable, which are less prone to its effects. Being mindful of inflation and making wise investment decisions can be essential for preserving and growing one's wealth. Hi! We hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comment section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and economy. Stay safe and look out for the next video.